Thank you, Peter, and thank you all for coming today. My name's Shawn Burns, as Peter said. I'm the portfolio manager for the Switzer Dividend Growth Fund and also the Contango Income Generator Fund. Now, both those, though they're both listed, what they have in common, they invest to generate dividend income, so they're income focused. And so we look for stocks which pay out high dividends and channel those through to investors in the fund. I'm also going to be talking about two income stocks that could benefit from Labor's proposed changes, and we'll go through those. Firstly, I might just set the framework of what is dividend investing. It's a bit different to total return investing, which probably 90–95% of funds do. They buy shares that they want to go up as far as possible. The essence is a bit different with what we do. We're buying companies that pay dividends. We want some growth in those dividends, but we want certainty and regularity in returns and high dividends so we can put those through to the investors. So it's a bit of a different focus. What type of issues influence the dividend investing? Interest rates are pretty important, what they're doing, because interest rates become competition for dividend stocks. And so low interest rates are generally good, and we're seeing worldwide low interest rates in the 10-year Aussie bond below 2%. That's low interest rates, look like they're going on for quite a long time, so that's positive. The world economy moves around. I would classify these risks as cyclical, whether we have a slowdown, how dividends are impacted by that, how much we'd like to buy companies that have solid balance sheets and cash flows and can exist through that, operate through those slowdowns and come out the other side. So the issues are temporary, and we've never held a company that has passed its dividend, that has completely stopped paying dividends. And it's because we purposely skew towards those less risky stocks, which we think will pay dividends through the cycle. Government regulation and policy risk, that's been an issue that's probably come to the fore in the last 2 years with the Royal Commission and also a series of other commissions. It's a bit harder to predict what the government's going to do, but I think that when we look at the stocks we invest in, what we like to do is avoid permanent capital loss because we want those companies to keep paying dividends well into the future. And probably I think the things that we've identified, which probably are the most risky when they come to these type of companies, is the level of debt a company holds, especially if we go into a downturn. Unfortunately, no one rings a bell and tells you when a downturns are going to come, so you have to prepare in advance. We like to buy companies that don't hold much debt, because if they do hold debt into a downturn and their business seems to suffer more than what they think, they become a seller of assets, a distressed seller of assets, and that destroys permanent capital. Also, obsolescence is another thing we try and avoid, because we're usually buying mature companies that pay a lot of dividends, stable business models. Any sense that their business is becoming obsolete is a bad thing, so we steer away from them as well. Now, I'd just like to go through a couple of stocks which won't be impacted by government regulation, so it looks like the ALP will get in. There may be some impact on franked dividends companies, people who get franked dividend rebates. So what we, and this is an area we've invested more in over the last probably 6 or 8 months. Both of our funds have increased our weighting towards these type of stocks, and they basically fall into the categories of REITs, so property trusts, utilities, so electricity and gas distribution companies, and also infrastructure, so airports, toll roads. So we've increased those, and why the way they set up the structure of that, they pay unfranked dividends. So they also have high dividends, and they're also stable business models, so they pay off a lot of cash. Now, one example that we've got here, and this is in the Contango Income Generator, which focuses on mid-cap stocks, so outside of the top 30 biggest companies. And this is a property owner, a hotel property group. It basically is a landlord to pubs, and also importantly has the licences, which means it owns a business as well. So it's very, very secure business. We like that. The counterparty is Coles, so a strong counterparty. This is the type of things we're looking at for these type of stocks. We like to see the weighted average lease of that's 4.7 years, so that's reasonable. These are fairly strong business properties they own. So and also the cost of debt is reasonable as well. It's a fairly small company, 487. But you can see with the REITs what they do hold a fair bit of debt there, but that is secured against the rental streams that they get. So these are the type of issues we're looking at when we look at companies like this one, and we do hold a fair few of these. They're stocks which probably are not that exciting from a total return point of view, but as dividend investors, we're after secure income streams. So we own a collection of these type of stocks. When we have a look at the share price here, this is interesting. As you can see, you've got sort of a slope over the last 5 years. You've got an upward trajectory in share price. That's good. Low interest rates help that. Also, the business is developing, adding extensions, etc., building the properties up, which adds to dividends. What you can see, the slight pullbacks in share price, and you see this. This is a common theme that we're looking at. Often that will happen when the market starts to worry about interest rates, that they're going up, and the share prices will fall. We use that as an opportunity to add to our positions if we think that's the suitable course to do. And you see that's a common thread through REITs, infrastructure, and utilities, that they are interest rate sensitive. So whenever the market gets nervous, and sells the stocks off because they think interest rates are going up, we've used that as a buying opportunity. The other stock I'd like to talk about here is Sydney Airport. I'm sure you're all familiar with Sydney Airport. We've all been through it many times, certainly I have. And why is this attractive? Regional monopoly, but also, and this is a common theme through infrastructure stocks like toll roads and airports, that they're incredibly stable businesses. Again, you can see like a sloping up towards the right, so dividends increasing. They've got confidence to say what their dividend will be this year. They're able to forecast their business reasonably accurately. Over the last several years, they've increased that as well every now and then. So what we're looking for is stable businesses which can grow over time. So you can see that. What drives that is the long-term traffic growth. You see domestic, international is especially important. So people coming to Australia, Chinese, more of them coming out. They're the biggest travellers now. They spend 5 times more than anyone else at the airport, which is good for Sydney Airport, so may many more come. I think that, again, when we look at the share price, you'll see these pullbacks here. Again, as I said, this is a common theme when we look at these type of stocks, that they are interest rate sensitive. So when the market gets worried about interest rates, they sell off. It's not only Sydney Airport and HPI, it's the whole raft of them. So we look through that and we make an assessment if that fear is real or not, and then we think not, we add to our position. So Sydney Airport, that last pullback around these levels, we're adding to it. And it's had a fairly strong run. You can see these stocks are yielding over 5% unfranked at the moment, so well above the cash rate. Just to talk about the two funds I run, the Switzer Dividend Growth Fund is a large cap. It focuses on yield and quality. You can see that it is listed. There's its ticker. I'm a shareholder in this, and I think and quarterly distributions, the historic yield has been 6.7%. That is made up of dividends from the bunch of companies we own, plus capital gains. So when you realise the capital gains, this fund pays them out. So you get them. We'll see how that goes this year. But that looking backwards, that's what the yield has been. It is exposed to equities. We like to think we're at the quality and lower risk end of those equities, focusing on dividend paying stocks, solid businesses, good cash flows. And you can see the investment committee there, all eminent people, probably well known to all of you. The other fund I run is a listed investment company, Contango Income Generator. Again, it's listed, the ticker is CIE. You can see that this is a little bit different, that it focuses outside the top 30. It's been going since 2015 and the prototype since 2012, so we've got quite a track record of following this. Mid-cap income fund, dividend yield is about 6.7. It's a company, so it's different to the other fund, and it has a discretion of how much it can pay out. Quarterly dividends, that dividend historically has been about 50% franked, and that is most likely to continue going forward. And it's, as I said, it's listed and you get liquidity on the exchange. So the two funds, the large cap portfolio funds are Switzer. It focuses on quality and yield in that top 100 base compared to CIE, which is the X30. When you blend the two together, you get a mix of stocks between the large cap and the X30. Blended together, it spreads your risk but keeps the yield up as well. So I own both these personally. That's a lot of my Australian core exposure. The way I look at that is that's the solid earners. If I want to take some risk, I look outside of that. That may be a strong growth company or a mining company that may find an ore body, etc. But this is like core Australian dividend funds that pay out a lot of the income. Just in conclusion, not all income stocks will be affected by franking changes. As the infrastructure, REITs, and utilities will be outside of that. They won't be impacted because of their low franking. We own a fair few of those in both of our funds. We increased those over the last year. The reason for that is not because of the franking changes. The reason is because we think they're solid businesses. We think the Australian economy is struggling a bit, and you can get a secure yield by blending these together in the portfolio. And also foreign earners is another way to they won't be impacted by the franking changes, but you're obviously moving up the risk curve by going out there. Switzer and CIE invested high quality income stocks, which together create a well-diversified income portfolio and represents a core holding in Australian equities.